Delta Airlines full year 2023 earnings report beat consensus expectations and boasted a record year, but shares ended the trading day lower for the company. The sell was attributed to lowered 2024 guidance. We think this is a buying opportunity, however. Let's take a look at the earnings in detail and see why. 2023 revenue came in at $58 billion, up nearly 15% year over year. Profit margin was 9.51, better by 31% or $5.5 billion. Net income was $4.6 billion, up 250% from full year 2022. Drilling down on passenger revenue, ticket sales in the main cabin were up 20% to $24.5 billion. Premium product sales grew by 26% to $19.1 billion. Loyalty rewards revenue grew by 19% to nearly $3.5 billion. And travel-related services, the slowest growing and smallest revenue segment, saw just 9% improvement to $1.85 billion. Some further data provided by Delta Airlines shows that per passenger mile yield was up 2% to 21 cents. Revenue by seat increased by 4% to 18 cents, though total revenue per seat was lower by 2% to 21.34 cents. Cost per seat was down 4% to 19.31. Passenger seat miles jumped 19% to 232.2 billion miles year over year, and available seat miles improved by 17% to 272 billion miles. The airline sold more seats at higher ticket prices amid lower fuel costs in 2023 compared to 2022. Turning to the per share ratios, the number of shares outstanding increased by 3 million, which will have a slightly worse impact on these multiples. Earnings per share jumped 248% to $7.16. Sales per share were $90 better by 14.2%. Cash per share increased by 21% year over year to $4.26. Book value came in at $17 per share, up 66%. The PE ratio is 5.4 compared to the S&P 500, just shy of a 26 multiple. Leverage ratios were improved too. The debt ratio came in at 0.23, better by 19%. Debt to equity improved by 50% to 1.56, and the interest coverage ratio at 6.62 shows that Delta is more than able to cover its interest payments. Liquidity ratios were all improved, with the current ratio at 0.38, the quick ratio at 0.26, and the cash ratio coming in at 0.1. The equity multiplier at 6.7 indicates that Delta is using a large amount of debt to finance operations. The firm took steps to reduce its debt load last year by $2.6 billion. We'll keep an eye on this ratio going forward. Return on assets were improved to 6.27%, and return on equity was good at 42%. Operating cash flow was $545 million. Investing cash outflow was only $535 million last year, and financing cash flows were $416 million last year. Free cash flow to the firm was a healthy $3.4 billion. Delta Airlines started to pay a dividend of 10 cents, yielding just 0.26%. Always a good sign that future prospects for the company are positive. Delta's enterprise value is $38 billion, which is a 0.67 multiple of revenue and an 11.5 multiple of free cash flow. Market capitalization to net income is 5.4 times. As mentioned, the company lowered guidance and are expecting a non-GAAP earnings per share of between $6 to $7 per share. And if we assume $6.5 per share, the company has a forward PE of 5.9. Free cash flow is expected to be between $3 and $4 billion. Key takeaways from this report show that the financials overall are strong. The dividend reinitiated is a good sign for the future. The low PE is attractive, and the leverage situation is improving. On the con side, however, the debt is still quite exposing the company to interest rate fluctuations. The PEG ratio is below 1 at 0.1. Economic factors and geopolitical tension make Delta Airlines susceptible to higher costs and lower passenger revenue. We give Delta Airlines a buy rating, and we have no exposure to this company. Like and subscribe.